Hello and welcome back to Market Brief After Hours. It's great to have you with us as we unpack a session that felt a bit like a tug-of-war. We saw investors trying to figure out where the safety lies, with a very distinct split between the old guard of financials and the new frontier of software.
It really was a day of reassessment. If you look at the headline numbers, things seem calm, but underneath the surface, there was quite a bit of turbulence. We're seeing this persistent worry about artificial intelligence. Specifically, is it going to disrupt the business models of the big software players? That anxiety capped gains in the US, while over in Europe, bad news on the jobs front was actually treated as good news for interest rates.
Let's start right there with the US indices. It looked like a struggle for momentum all day. How did the big three actually finish up?
It was a photo finish, barely in the green. The Dow Jones Industrial Average managed a modest gain, adding about 32 points. It closed up 0.07% at 49,533. That was largely thanks to the banks. Citigroup and JP Morgan had strong days as investors rotated out of tech and into finance.
And the S&P 500?
The S&P 500 was also capped by that software weakness we mentioned. It rose just 0.1% to finish at 6,843. It felt very range-bound. You had financials pulling one way and software pulling the other.
Then we have the Nasdaq. It's been on a rough run lately. Did it manage to break the curse?
Technically, yes, but it wasn't a convincing victory. The Nasdaq Composite added 0.14% to close at 22,578. But keep in mind, this index is coming off its fifth consecutive weekly decline. That's the longest losing streak since 2022. Even with the slight rise, the pressure is undeniable. We saw heavy losses in big names like ServiceNow, Salesforce, Oracle, and Palo Alto Networks. The market is really questioning the valuations of these high multiple stocks right now.
It's interesting to see that rotation. Let's hop across the Atlantic. You mentioned that in Europe, the mood was a bit brighter, particularly in the UK, but for a somewhat counterintuitive reason.
Exactly. The spotlight was firmly on London. The FTSE 100 actually hit a record high, closing near 10,556, up 0.8%. The catalyst was the latest labor market data. UK unemployment climbed to 5.2% for the 3 months to December. That's the highest level in 5 years.
Usually, rising unemployment isn't cause for celebration.
In the real economy, no. But in the financial markets, bad economic data often fuels bets on rate cuts. The market looked at that 5.2% unemployment rate and the softening wage growth. Average earnings rose 4.2%, which was below forecast, and decided that the Bank of England is now much more likely to cut rates in March. That optimism lifted the whole market.
And how did the rest of the continent fare?
It was a sea of green, mostly. The broader STOXX 600 advanced 0.5%. In France, the CAC 40 gained about 0.58%. In Italy, the FTSE MIB was up 0.82% to 45,792. Germany's DAX also rose around 0.8% to 24,998, and the Swiss SMI added 0.71% to close at 13,753.
Was it all clear skies in Europe, or were there any clouds?
There was one dark spot. German investor morale took a hit. The ZEW expectations index slipped to 58.3 in February, which was well below what analysts expected. It just highlights that even though stocks are up, the economic engine in Europe's largest economy is still a bit fragile.
Before we get into the technicals of the currency markets and the individual stock movers, let's touch on Asia and commodities. It sounds like a quiet session in the East.
Very quiet. We're in the middle of the Lunar New Year holidays, so major exchanges in China, Hong Kong, Singapore, and South Korea were closed. Japan was open, though. The Nikkei 225 fell 0.5%. Down under, Australia's ASX 200 managed to trade about 0.5% higher, but New Zealand's market dropped 0.7%, marking a 3-day slide.
And looking at energy, oil prices took a step back?
They did. Geopolitics is driving the bus there. Iran's foreign minister signaled some progress in nuclear talks with the U.S., and that eased some of the risk premiums. U.S. crude dropped nearly 0.9% to $62.33 a barrel, and Brent fell 1.79% to $67.42.
And precious metals? I saw some ugly charts for gold and silver.
It was a rout. Gold fell heavily, down 3.18% to close at $4,882. It failed to hold its rebound from record highs and just slid. Silver was even worse, down over 5% to $73.33.
We're going to take a quick break. When we come back, we're going to dive deep into the Forex markets, specifically looking at those moving averages you need to watch. And we'll break down the massive M&A news that sent some stocks soaring over 30%. Stay with us. Welcome back to Market Brief After Hours. We've covered the broad equity markets, but now I want to get technical. The currency markets had some very specific moves today, especially with that UK data we discussed. Let's start with the euro against the dollar.
Euro USD is in a bit of a holding pattern. It edged slightly lower, down just 0.02% to 1.1849. It's consolidating after a strong run-up.
For the technical traders listening, where are the support levels sitting right now?
The picture is still constructive because the price is holding above all the key moving averages. The pair is comfortably above its 50-day simple moving average at 1.1764. Below that, you have the 100-day at 1.1687 and the 200-day at 1.1638. As long as we stay above that 1.1805 zone, the bullish bias is intact, but we are seeing some hesitation at the highs.
Now, sterling must have had a rough ride given the unemployment news.
It certainly did. GBP USD pulled back sharply, closing down 0.51% at 1.3561. The softer labor data really weighed on the pound. Technically, it briefly dipped below its 50-day SMA, which is at 1.3518, but it managed to recover slightly into the close.
So it's testing that support?
Exactly. It's still above the 100-day at 1.3393 and the 200-day at 1.3440. It looks like a corrective phase rather than a total trend reversal. But if it breaks 1.3486, we could see a deeper drop.
And that weakness in the pound must have helped the euro against sterling.
Huge move there. Euro GBP surged 0.53% to 0.8738. This was a decisive technical breakout. It smashed through the 50-day SMA at 0.8699, the 100-day at 0.8724, and the 200-day at 0.8657. Closing near the highs suggests a real shift in momentum.
Let's quickly hit the loonie and the yen before we move on.
USD CAD is consolidating after a steep sell-off. It finished marginally higher at 1.3639. However, the trend is still bearish. It's trading well below its 50-day SMA, which is way up at 1.3732. The 100-day is at 1.3870, and the 200-day at 1.3817. It's struggling to find upside traction.
And the yen?
USD JPY slipped again, down 0.17% to 153.26. It's below the 50-day SMA at 156.03 and the 100-day at 154.61. However, it is still trading well above the long-term 200-day SMA at 150.53. Buyers are trying to defend the 152.70 area, so that's the level to watch.
Excellent breakdown. Now, let's shift gears to the individual stock movers. We had some massive moves today driven by Takeover news.
We really did. The biggest story is probably in shipping. Zim Integrated Shipping Services surged 25%. Hapag-Lloyd, the German container group, agreed to acquire them in a deal valued at $4.2 billion. That triggered a repricing across the whole sector.
And there was another big acquisition rumor in medtech?
Yes, Massimo. Shares jumped more than 34%. The Financial Times reported that Danaher is closing in on a deal to buy them for nearly $10 billion. When you see premiums like that, it wakes up the whole market.
Activist investors were busy too.
Norwegian Cruise Line rallied over 12%. The Wall Street Journal reported that Elliott Investment Management has built a stake of over 10%. Investors usually love it when Elliott gets involved because they push for changes to unlock value.
But it wasn't all good news. We had some significant earnings misses.
Unfortunately, yes. General Mills slumped 7%. They cut their 2026 outlook, forecasting organic net sales to decline and operating profit to drop. That's a tough pill for investors to swallow. And the worst performer in the S&P 500 was Genuine Parts. They slid more than 14% after their quarterly sales of $6.01 billion missed expectations.
So, looking at the big picture to wrap this up, we have U.S. tech struggling with AI fears, UK labor markets cooling, and massive M&A activity popping up in specific sectors. What is the takeaway for the listener?
The takeaway is caution. The market is becoming very selective. It's not a rising tide lifting all boats right now. You have to look at relative value. Investors are rotating into financials because they look safer than high multiple software stocks. They are looking at Europe for rate cuts. It's a risk-aware environment where you really need to be paying attention to the specific drivers of each sector rather than just buying the broad index.
A selective market indeed. That is all we have time for today. And thank you for listening. If you find this useful, please follow Market Brief After Hours to get these updates delivered straight to you. We'll catch you next time.